Tonight is going to be more of an open discussion. I wanted to talk about doing some trades outside of our core positions. I go over this concept in detail in how to find trade ideas in the Dorian Way School. This is lesson 9. I'm going to refer to this lesson a little bit today, but I'm not going to go over this lesson. I kind of want to talk to you outside of this because I do go into this in more detail in course 2, but just to give you an idea on how to place stuff, how to place trades in something that's outside of our core positions. Once again, as you probably already know, all right, so our core positions are the ES, /ES, /RTY, and /NQ. When we are doing a core position, let's say in the ES on the put side, we start off by doing a 100-point wide spread, starting with the 5 delta, then we work our way up to the 7 delta. So if we were doing it here, we would click there, and then we would go 100 points lower, which would be the 25.50, and that would be the put side, and then we have some criteria around that. If we were doing the call side, and when we're doing the put side, it's 200 points wide on the NQ. So when we're doing the call side, it's the same for all our core positions, and it's 50 points wide. We go to the furthest from at the money, 5 delta, and as you can see here, this is the furthest from at the money, 5 delta. All right, so I'm going to click on that, sell that furthest from at the money, 5 delta, buy 50 points higher, which would be the 33.70, and this is how we do our core positions. We can adjust to move it, to make this spread less. Only time we will make the call side more is if we did a rollout and we need some more capital, we would move that to 100 points wide. Outside of that, we're never doing wider than a 50-point spread, or we hardly ever do, I don't want to say never, more than 50-point wide. On the put side, you should never do more than 100 points wide, regardless if you're doing a move out, a rollout, or some type of adjustment. You want to keep it within 100 points. So if you're doing an adjustment and you have a position on the 100 strike, then you're going to make it 95 or 90 points wide. If you're doing a put spread and you don't have you can't do 100 points wide because it's the next strike is 105 points wide or something like that, then you would go less than 100. Then you would you default to less than 100. All right, so when we're doing a trade outside of the core positions, let's start off with the bonds here, and let's go to the 44 days. So when we're doing this, what we want to first start off with is obviously the 5, between the 5 and the 7 delta, but we also want to look at the expected move, and you're always going to get the expected move over here to the right of the option chain when you're looking at whatever days to expiration. In this case, we got 44 days for expiration, and we want to be 2 times this expected move on the call side or on the put side. Ideally, that's what we want to do if we're going to be putting on a trade there. So in this case, it's basically 6 points down. So it's trading at 157. So we're looking at that 151. And as you can see here, this 151 is the 11 delta. So we wouldn't do the 11 delta. The highest we would go is this 149 delta. Or if you want to be a little semantic, since they don't have a 7, you might be able to go to this 8, and that's still fine since they don't have the 7 delta, and we normally trade in between the 5 and the 7 delta. So when you're doing something outside of the core positions, you want to be 2 times the expected move. 2 times the expected move. We're not going by a percentage from at the money. We don't go by a percentage at the money. We go by 2 times the expected move. In this case, once again, it is basically 6. So we would sell the 150 or the 149. So if we sold the 149, let's do that here. All right, so let's sell the 149, and we would not do 100 points wide. We wouldn't go to the we wouldn't go to the 49. Okay, that's just way too big. We wouldn't do a 50 point wide. What we would do is base it on where we can get some premium at. So you're looking at, and that the max loss is no more than $5,000 on one contract, but ideally no more than like $3,800 on one contract. The smaller your theoretical max loss, the better when you're trading things outside of our core positions. So looking at this here, you have these positions right here. Once you get lower in these 1 deltas and so forth, you don't have any more premium really, right? So I'm looking at this and I'm saying I would probably go no lower than the 144, most likely no lower than the 145. And I would base that on how much it's going to be buying power wise. And the ZB is a big contract, so let's clear that. And let's try to buy the 44 here. And this is like a 5 point wide spread. So we buy that. And then when you look at this, you can do it, right? You can do it, but it's still not ideal. Meaning that if you look at this here, it's under 4,900. You have theoretical max losses under 4,900. You're receiving only 94 before fees and commissions. So this is going to be actually less than 94. So I wouldn't do this type of trade, right? But we could hit edit and see what happens if we bring it in a little bit. So we brought that in. Now it's at 3,900, which is the theoretical max loss. And once again, I'm looking at this area right here. So we got theoretical max loss of 39, and the price didn't change. So obviously you want to get closer to at the bring in that spread, have a less, the width of the spread less if you can get a decent amount of capital still. All right, so let's delete that and let's move it in one more time. So now we're at the 46 delta, and it still hasn't really changed this price here. So, but the theoretical max loss has changed quite a bit. All right, so let's delete that and do it one more time. And now we're doing a 2 point wide spread. It's changed here to the 5, and our theoretical max loss is 1922. So you're only getting $78 after fees. So what you can do here is add a second contract or skew this and do the call side. I would probably add a second contract and do something like this. So now if you hit review, you're getting 156 before fees, hit review afterwards. So let's hit this and look at this for a second here.
I got a question.
Yes.
So what is the ideal credit that we should receive when we're dealing with bonds?
So the ideal credit you want to receive when you're dealing with anything is at least $100, right? But that all depends on your account size. So you're going to have to adjust the WIFs to be able to make sure that you can get $100 without putting too much pressure, too much buying power, too much of a theoretical max loss. So in this case, with doing one contract, I wasn't able to receive $100. But bringing in the spread to a 2 point wide and doing doing two contracts, I'm able to get this 141 after fees, and that's definitely over 12% on the buying power. So we don't worry about how far we're from at the money, because we cover that when we're doing this expected move, 2 times expected move. So you wouldn't go wrong if you're trying to get at least $100 on everything, or very close to $100. If your account is smaller, then you can play with that and get something less. Like for obviously, if you're selling a call spread and you're trying to get at least $50 after fees and your account is small, you don't want to add another contract to get that 100. Just keep it at that 50 on that call side with that 50-point wide spread. But and if your account is smaller, or if you have a buying power issue but you still want to put on a trade and you want to stay within your buying power, then instead of doing 100-point wide, maybe you bring it into 75 points, or maybe you bring it into 50, and you can still get a decent credit for how much the buying power is required. So that is how you can look at that, Johnny. Hope I answered your question. Please keep them coming. All right, so this is how I would do this trade on the bonds. This theoretical max loss is less than what I would did if I did that original trade of about 5 points wide or even the 4 points wide. This is still less than that, and we're doing 2 contracts and we're getting a decent amount. So I would take that 141 and then I would hedge that. Right, so I would initially try to hedge it in the ZB, but it's probably going to be way too much to hedge it in the ZB, because you got 141 times 30%, that is $42. So you're not going to be able to hedge that in the actual ZB underlying. So if I go here and I look for the 30 delta, I don't have one, so I'm going to go to this 20 and I click here, then I 28, and I buy 1 point lower. Then this is going to be very expensive, as you can see before we even click the button to see. This is already $768 to buy that. So that's too expensive. Obviously, we can move this down away from at the money and keep going, but we would have to go pretty far. So that's actually, I was looking at that wrong. That was max profit. Excuse me. See, you guys didn't catch that. Always looking at that max profit.
I did see that. I did see that, but
okay. All right, so it's still going to be too much, as on that 28 delta. As you can see here, looking at the right area now, this one here is still before fees. It's $234. So if I delete that and then I go down more, I'm still gonna have to go down pretty far before I get the before I'm $42 after fees. This is the 8 delta now, and it's still too expensive here. So you can't do it there, but you will be able to do it in the TLT. This is the bonds equivalent. This is the one you would go into, and then you would just go into the same expiration period. I think we were looking at the 65. I forgot, but it's just regardless of what we were looking at, you try to go to the same expiration period. If you can't, you go into the one just before your expiration. And if we bought this at the 30 delta and sold 1 point lower, we would be able to get this. This is $28 before fees. So obviously, if after fees, it's going to be only 30. So that meets our criteria. Now we've hedged it, and we've hedged it on the put side. If you did a call spread, you would hedge it on the call side. So let's look at that ZB on the call side. So we trade ZB kind of, this is 30-year bonds. We trade this kind of often. So it was a 44-day. All right, so we're looking at the 2 times expected move again. This time we're going to do the call side, right? And when you're trading bonds, the risk is to the upside. That's where the most of the premium is going to be. That's how far you can get further away from at the money on the call side. When we trade in our core positions, the ES, the NQ, the RTY, the risk is to the downside. That's why we can get 10 to 12 or even more % away from at the money on the put side, and we have to be 5.5, 6, 7% away on the call side, because the risk is to the put side. So the skew, the option skew, is to the downside on those core positions. On most positions outside our core, the risk is going to be to the upside. So you'll get a little bit more premium. So we're going to go 6 times the expected move here. The 6 times expected move, so it's the 57. So we're going to want to go to at least the 163. So if we go to the 163, this is only the this 163 is the 8 delta. We could do that, or we can do this 6, right? So let's look at this 6 here, and let's do the same type of concept. You're gonna pick which one still has some meat to it. So let's do a 3-point wide here, and so doing a 3-point wide is only $78, so it's less than. It's not that much afterwards. Theoretical max loss is less than three grand. We hit edit here, and if we move this up again 2 points, this is actually going to be less on the call side this time. This is one of the rare times with the bonds, it's more skewed to the downside. Almost 100% of the time, it's going to be skewed to the upside, because when the market goes down, usually a flight to quality is to the bonds, so people buy it, so the price of the bonds go up, and the yield then goes up. When bonds are going down, the yield prices are going up. It's the opposite. So this is the trade we would do too. This would give us $100, and there's still our theoretical max loss right here is still under. It's about 3,800 where we want to be, and when we're doing something like this, and this would meet the criteria. All right, so let's move on and look at something else. Let's look at.
Got a question.
Yes.
For the call side, the requirements are the same as you would on the put side. So under 5,000 max loss, $100 credit, and 2 times the expected move.
That is 100% correct. That's correct.
Okay.
And you can get these, if you don't remember this criteria, you can get this from lesson 9 of the Dorian Way School. But I'm just going over this in more of a discussion form tonight. That 5,000 is the max, right? You don't want to really do that. You want to try to get closer to the 3,000 range for one contract. Obviously, if you're doing more than one contract, 2, 3, 4 contracts, then your max loss is going to be over 5,000. But I'm talking about for one contract. For one contract.
Now, the short put was within the 2 standard deviation on the last trade that you put up.
The short put was outside of there. So let's just see.
I must be looking at hold on.
This is it right here. It was outside. We did the 149. And that was 2 times the expected move. So if you go to 6, right? If you subtract 6 points from here, it's going to be 151. We were doing the 159, 150. So we were still 2 times the expected move, which is the two deviations.
Okay.
Let's move on to this one here. Let's try gold. We trade gold quite often. So looking at the GC, this is the gold contract, and the risk to gold is usually to the upside as well. So let's start off with that. We're looking at the expected move again, which is the 36. So you're going to go 36 times 2, which is 72. So you're going to try to be 72 points ahead. So we are at the 42.62 plus 72. We have the 15.34 is where we want to be at the closest on that call side here. So when we go to the 15.34, this 15.35 here is the 14 delta. So we wouldn't do that because we wouldn't want to be higher than the 7 delta. So this is where you're going to see the skew at. So we're going to go to the 7 delta here and sell the 15.70. And this is way more than 2 times the expected move, right? So you go 36 times 3 is 108. So plus the 14.62. So this is over 3 times the expected move away, right? So this is really good probabilities that this is going to work out for you. And you have this 7 delta here. So let's figure out where we're going to put the spread at, right? So we're looking at these different prices. Let's start off with a 20-point wide spread here. And we're going to buy this one, and then we're going to look at the expected, the max loss here. So theoretical max loss. All right, so this is 1930, so I like that, right? We're only receiving $70. So if we wanted to receive at least 100, so we need to adjust this, right? So we can either change it and add another one, right? So now we're at 140, and the theoretical max loss is 3860. Okay, it's 3860, but the buying power is at 772. But that's still going to be the 12% at least, right? So you can do this trade. It's not too bad for 2 contracts, but you can edit it and try to optimize the trade even more, right? So you can bring up this long leg, and now we brought the long leg up to 5 more points, and this is what it looks like now. So so it's going to be under 100 after fees, but you drop that max loss a little bit. So but that's 82. So I like the first trade better, right? I like the first trade better because I'm getting a little bit more. So it's not too much of a big difference. All right, so if I hit clear and I go to the put side now, and I take that 1462 and I minus the 72 from the expected move, we want to be at least the 1390. So I'm going over here, and the 1390 is the 6 delta. So I can sell that and see what we can get. So I sell that, and let's start off with a 20-point wide as well. So I'm going to the 1370, buying that by clicking on the ask, and I'm getting $6 on this one. And we're instead of being 3 times the expected move, or 2 times the expected move, because once again the risk is to the upside on the gold, so you can get further away. Now this is $60 before fees. Once again, I'm looking at this here before fees and commissions. The theoretical max loss is 1940. I'm going to remove that, and let's see what we can get. Let's see if we can move this here. So now we're getting 120 before fees, 3880 max loss. So this is a decent amount, right? But this time it's telling me that I'm only getting about 10%, right? So I can't do this trade. I would have to do some type of adjustment on the put side. If I wanted to do the put side, I can't do this trade because it's not meeting the 12% requirement. So what I can do is go and hit edit and see what happens if I bring it in, what happens to my buying power. So I brought it in a little. I'm still doing 2. I hit review, and it's still 10%, right? And I'm under $100. So I'm not going to be able to do this trade. I don't want to be higher than the 1390 because that's 2 times the expected move. So I wouldn't do this trade on the put side. I could, on the other hand, let's say decide to iron condor it off, right? So I'm just going to change this back to 1 for a second, and then I can go to the call side and I can put that on. And before I was looking at I think it was the 6 delta or something like that. Let's try to see what happens at the 5 delta. So I do 1585, and then I do 20 points wide. So let's do the 1605, and let's see what this looks like. Right. So now I got $100, 19 theoretical max loss, and if I hit 2. So now I'm getting $200, right? I was getting after fees, it's going to be a little less than that, obviously. So I'm going to hit this. I'm going to look at that, and my theoretical max loss is the 3,800, right? And that's due to the call side because we brought the put side in a little bit. So the max loss is on the call side. And if we do that 165 divided by the 874, that's going to be 18.8%. So that meets our criteria, and you can do that trade. Or you can just keep what we originally had on. So on that call side, you can decide to move that up to that 1577. Moving it up, you'll use this arrow, And 1575, we just moved it to the 1575, 2 contracts still, and didn't change that very much. Interesting. So I thought it would change it a lot more. Normally it would change it, it changed it by what, $40 or something like that, which, okay, not bad. 185 divided by the 865 equals 21%. So you're getting a little better. Instead of 18.8%, you're getting 21.3% here on this trade. All right, so let's do something a little different now. Let's go into some currencies. So let's try the 6E. The 6E is the euro, okay? And then we go to 51 days, and you're gonna do the same type of concept here. You're looking for 2 times the expected move. So this right here is the expected move. So what I'm just gonna do is take that 1 and subtract it from this 10, and I'm gonna look for 8 on the put side and look for 12 on the call side, 112 and 18, okay? So 108 on the put side and 112 on the call side. And when you're doing currencies, it's no skew unless it's some type of situation going on, because currencies can go up or down. It's no directional risk where it's normally a directional risk, like it's directional risk to the put side on our core position once again, and it's normally a directional risk to the upside on other stuff like natural gas, gold, oil, stuff like that. So I'm looking for, in this case, I'm looking for the 2 points down. This is the 1 point, this is at the 8, it's the 7 delta, so I can actually do this. I'm hitting that, and in these I usually only do a 1 point wide spread. And let me show you why. So I'm clicking this here, and this is 1 point wide. Just on that 1 point, it's already a theoretical max loss of this 1,200, right? And then you're only getting $50. It's still over 12% because this is the buying power before we look at it, right? So, but it's a lot of fees associated with some of these things. So if we click here and look at review, so we have the normal commissions to put it on is $250 an option for futures. And once that comes off, once we take it off, we won't have this, but we will have this 384 still. So let's hit edit. And if we did 2, then that's still not bad, right? 2,400, hit review. We're under 1,000, excuse me, 100 still. So we would have to do 3. So, we change this to 3 by clicking on the quantity, hit review. Now we have the 3, right? So we got 123 divided by 941. It's still a lot for this account. So but it's 13% though. You could do this trade, theoretical max loss, even with 3 contracts, is still only 3,600. So I like this probabilities. I don't necessarily would just base it on this. I would base it on what's been going on with the trade. So for example, if you were looking at this and you went to a chart, right, and you put in the 6E, and I would determine, okay, what am I doing here, right? So in this case, since it's been going down a lot, it's been in a range, but mostly down. So I'm trying to sell a put spread here, right? But if I was being greedy, I could try to sell a call spread, but I would sell it up here to give it a chance to go back this direction, okay? All right, so let's go back there and let's just look at how that call spread would look on here. So that's the put spread, and we're getting 123. It's about 13% on our buying power. Hit edit, and then let's add the call side really quickly. So we want to go 2 points at least, so the 112 at least. So this is the 112 at the 29. So the risk is to the upside right now based on these pricing. So we're going to go a little further out, and we're going to go 2 times the expected move. This is the 8 delta. Since they don't have a 7 delta, we could try the 8 delta. So let's try that for this time. So we're only buying 1 point wide. Okay, so we're only going 1 point wide. So we hit that, and now we have 3 contracts on. The buying power is pretty much the same. We only went up about 100 or something. So you got 246 now divided by 952. That is 25.8% on your buying power, right? So it looked like the put side was causing the stress, right? So maybe instead of a 1 point wide, you bring it in a little bit, right? So you bring it in there, and it changed the buying power a little bit, right? So it dropped it back down maybe $100. So let's see what happens if we move this whole spread down like that. All right, so not a big difference. So let's move it back. And then you can try, this is just trying to optimize the trade the best way possible. So maybe you move this in, see what happens, right? So now your buying power went from 800 and something to 533. So that's a big drop, and you're doing 3 contracts. So this will be the trade I would do on this. So the 134 divided by the 586, and that's 22.8%. So you're still getting a very good return, and your max loss on this now, if you would have that, and we don't do that the Dorian way, is 1688. So you just figure out a way to optimize this trade the best way, right? And that's subjective, right? And that's all based on your account and things like that. But this is how you want to manipulate every trade that you do. You don't have to just go by in our core positions 50, 100. You can bring those in. You could adjust the sides, whatever the case may be. You can only do one side. You can do both sides. You want to understand that you can adjust it to fit what works best for your situation.
Question.
Yes.
So for the credit, the ideal credit of $100, it doesn't have to just be for one vertical spread. It can also, we can also use an iron condor to satisfy that as well.
Yes, you can. But if you're looking at, like we were looking at this graph here, you don't necessarily need to do an iron condor, right? You can do a put spread here. Just because you can do an iron condor doesn't mean you should. But yes, if I would do an iron condor here, I would skew it, meaning that I would make sure that my put side is giving me more. My put side is more risky than my call side, because I feel like this might go back up this way. So I'd rather have less risk on this side than on the put side. Does that make sense, Johnny?
Yes, it does.
Okay, good. Let me see if I can find something that has more of a range that we've been looking at. All right, so this is wheat, and normally the risk is to the upside, but this is one that you can look at. This is a chart you can look at and say, you can probably argue that an iron condor would be very, very safe in here, right? So since I understand that the upside, the risk, the velocity of the move is to the upside, I would try to be up here on that spread and down here on the put side. So if we did this trade, this one showed you how to optimize that and so forth. So if we did the ZW, all right, so the ZW, I would go to the 44 days here as well. All right, so the risk is to the upside. So let's just say 20 points, right? So $40. So you want to be at least at the 548 on the call side, and you're going to see that we can be a lot further than that. So this is basically the 548 here. So this is the expected move. This is the 2 times expected move around this 48 here, right? But that's the 14 delta. So we don't have to do that. We're going to do this, the 8 or the 6, right? So let's do the 8 here, and we sell that. And so we're a little further around the call side, and then just start off with the 20 points here. So we go with this 1585. So you can see on this one, it's a lot of fees. Max loss is almost 1,000. It's only $31 there. So if we increase this width here, so we would have to go to probably 4 contracts on that call side before we hit the $100 range, right? So we have these fees, which is $18. You're gonna have those same fees when you get out of it. You won't have this again, but you can see that we receive 125, but we're still only getting 86. There's a lot of fees in the wheats and the corns and so forth. So, but if you hit edit, right, and you decide that, all right, let's try that put side. So we have the $40, the 508 minus the 40 is the 4668. So let's look for that here. So that's around here, which is a 7 delta. Let's sell that 7 delta, and let's buy 20 points lower. And so the theoretical max loss is still is a little less, but we're getting a little bit more credit, obviously, but our buying power is $1,000. It's still more than 12%, but you can see it's requiring quite a bit there. If we lowered that to 3 contracts, we're still getting 130 over 82, which is not bad. And you can see which side is causing more of the problem. You can bring this in, see if that changes. That changes to 577, and so you're still getting basically 130. And let's see if we bring it in one more time, and it didn't do anything that time. You can try the call side and see if you can maximize this a little bit, optimize this a little bit better. So I'm going to bring in this on here, and this is done. It did nothing to my trade on the buying power wise. Obviously, it gave me less credit. All right, so that's what I mean by doing these kind of trades. I usually start off with a 20-point wide, and then I move it in and in for stuff that's outside of currencies. Currencies, I only go 1 point wide, sometime 1.5 points, because currencies are pretty big. Just for 1 point, it's quite big theoretical max loss. All right, so that is what I wanted to cover tonight, to kind of give you a view into trading things that are outside of the core positions. I go over this more in lesson 9, and then I go over it in a very robust way in course 2. I haven't obviously put that on the website yet, but I will. But if you have, if you've paid for more than 3 months, you will run into a lot of stuff in the course 1. That's gonna be course 2. All right. So, any other questions before we conclude? All right. So I thank everyone for joining me this evening for this Wednesday night webinar. I will send this out once the recording is complete. And if you have any questions after that, please let me know. Once again, thank you for joining me tonight. Good night, everyone.